Hey, good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. Exciting show for you today because this morning we got good news out of the GDP number. Grew at 2.8% when we were only expecting something like 2.1% for growth. Again, this is the second quarter. These things, look in the rearview mirror about how things went during the second quarter. So ultimately, that is good news. The economy is growing. However, as you know, with markets, good news is sometimes good news. Good news is sometimes bad news because it's all tied into rate cuts. But I have a special guest for you named Mike this morning that is going to break all that down for you on whether it's good news or bad news. He'll walk us through that. And then he's going to talk about of course, stock market cult favorite that we have largely passed on because it was too expensive. A stock you may have heard of called Nvidia, and it's just like, we've been saying it's too expensive. Well, guess what? It's 20% off of all highs. It's post split below that price, if you remember any of that stuff. And I have sat across from the table from clients and said, we're waiting for a better price. Guess what? Mike's going to talk to his opinion on whether that better price is now and it's time to move in. And then lastly, if that's not exciting enough, we're going to dial it way back to like boring things like CDs. And I'm going to go through the CD rates that are now available because I do get that question. We benefited from 5.6, 5.65 rates there for a little while for a 1-year CD. That's coming down, so we need to temper expectations for what we can get out there. And I'll cover that at the end of the show. Before we get started, this is a financial education presentation. You have to do your own due diligence for acting upon anything you hear in this presentation. The more disclaimer information is available at ankerstarwealth.com, and the opinions expressed are Mike and mine's alone. And let's start with Mike's opinions on what's going on with this GDP number.
Yes, it was an interesting morning. I'll start off by showing the greens. I didn't put on a green shirt, but I like to see the green. But here's the thing, the timing of our show sometimes could mess you up. Because if an hour ago we would have hopped on, you would see things in the red. And I thought this was really interesting, and I was stunned. And I'm going to go over the GDP number in just a few minutes, but I wanted to show it good now. But I want to show this is probably why you don't want to look at this stuff all the time, hour by hour, because this is what the NASDAQ did this morning. It's the primary tech index that tracks very closely to kind of like a lot of our holdings. And you see that big drop at 10:30. The NASDAQ was sold off, dark in the red, less or down 1%. And I was like, I can't even believe this. We're getting great news. Is this the good news is bad news thing? And since then, you can see it's vaulted up. And once again, this is why you don't want to look on this hour by hour, because you're like, why? Why would it do that? Because look at these fantastic numbers. While we do see, the economy is slowing, I'm seeing it, with some different stocks that we track, some things that are on the pulse of the consumer. We're seeing things slowing, but when we look at the second quarter, we are nowhere near slowing to a recession or anything. In fact, it was surprisingly higher, 2.8%, as opposed to a 2.1 forecast. I've seen a 2.0 forecast, but that is the good news. This economy for the United States, especially, is doing fantastic. Within it, too, there's some other numbers we want to look at. Personal consumption, that's actually up 2.6%, but slowing from the first quarter. And here's the key one. The core PCE prices, they were up 2.9%, but also slowing. So that reflects inflation slowing. So right now, that soft landing we talk about is looking better and better. The economy's continuing to grow, inflation's continuing to go down, and of course that rate cut, that we're always talking about is on the horizon. What happened today, does that change it? I don't know that it fundamentally changes the timing, but it's just overall good news. One thing, I'd say also is, it says the personal savings rate continues to decelerate. That might not necessarily be a good thing, that people are saving less. But, since our economy is driven by consumer spending, there's a balance. We want people to spend, but we also want people to save, because that's how they prepare for retirement and things like that. So overall, good news. I saw this article that, nice headline: the U.S. economy is pulling off something historic. And obviously headlines are meant to get you to click on it. But I did like it. It says, consumer spending is Americans' economic engine, accounting for 2/3 of the output. People are continuing to put out money. So, good news for those of us who own these companies that people invest in. Steve brought up the other topic, Nvidia, and when this stock, has had a meteoric rise. I could show you the graph, from a year or two ago. It's incredible, but it touched $140 a share, and fantastic company. Even though Jensen Huang is not accepted my friend request on LinkedIn, I don't know why, but still, I like this company. It's done great. Obviously, what they're doing, driving the AI. Key component, has battled Apple and Microsoft to be the most valuable company. It's dropped a little bit, and that's why there's an opportunity here. It's now the number 3 company, but it's basically almost 20% off, and it's fluctuating right around there. It peaked at 140. You can see 140.76, and it's touching, when it gets down to about 112, that's a 20% off sale. Now, did something change in the last month that makes Nvidia less valuable or not as great a company? Absolutely not. It's just 20% off. And that is why we're looking to figure out, in some of our more aggressive models, places to have direct exposure in it. We have had indirect exposure in it through JTech, because that's the largest holding within that ETF that we hold. So we do get exposure to Nvidia, but now we're looking to add it more as a primary part of our portfolio in the aggressive. So I like where it's at. Interesting, check out its one-day graph. You can see this thing bounce this morning. It's a big driver of the NASDAQ. So you can see the bounce. But what I'm looking at really is, look at it over 3 months. It's kind of traded flat, and when it flat, it's kind of flat, But the expectation is, as it regroups, as the our country starts cutting rates, as we grow faster and faster, and companies continue to invest in AI, this Nvidia will be a direct beneficiary, and it should. Obviously, we wouldn't invest in it if we didn't think it was going to go up. So with that, I'll turn it back over to Steve and the exciting CD discussion.
You can't just go right into something as exciting as CD. So I do want to say, Mike, as always, I'm here to hopefully provide you the resources to be successful in your role. And part of that, I have also on LinkedIn, as you were talking, requested Jensen to be a friend or a connection or whatever it is on LinkedIn. So it's not a competition. It's simply to say that if he accepts that, and so far he has not in the past 60 seconds, that I can put in a good word for you and maybe recommend. Maybe I send him a picture of you dressed up as him off the show from earlier in the year. So I'll keep you abreast of what's going on there. All right. So now that we have that out of our system, let's talk about CDs. I do, so right now we got up to like 5.6 earlier this year, to even have a couple of 5.65s out there. Now what this chart is showing you, I have searched, this is inside Schwab, this is real time. It's real time, is 5 minutes ago, and if I refreshed, it'd be real time. But when you look, I searched by coupon, so everything, if you look in this fourth column over, is where that's your return, right? I only use banks we know, so even though one local bank might be your local bank, it's not mine, so I'm not giving them money for clients, right? So let's go all the way down to a bank I've heard of called JP Morgan Chase. I moved it up to the top, and it's a 1-year CD. A lot of those, this is the first of the list that were, a 1 year. So you can, right today, right immediately, get a JP Morgan Chase 1 year 5.15% CD. It is callable. If you see that in the title, that means they can retire it early by just simply giving you your money back and stop paying interest. There's a schedule for that. That's kind of in the weeds. Just know that, sometimes they put that caveat in there, but really, so that's what I would call right now the risk-free rate. USFR, which almost every account has a little piece of USFR, is a floating rate U.S. Treasuries fund that we use by Wisdom Tree. It's paying around 5.3%, but that's gonna fade fairly quickly. I was talking with the client yesterday, and it's just like, I was like, oh man, 5.15 sucks, and I'm like, well, time out. It sucks compared to 5.6 that we could have gotten, 4 or 5 months ago. But let's rewind 4 years ago when interest rates are sitting at 0, and nobody even talked about CDs because they were too low to even get out of bed and talk about, right? So and now, back then we talked about the war on savers or the war on elders, right? Because a lot of the times it's the elderly folks that would love to be sitting in CDs making risk-free returns so they don't have to deal with watching the market every day and the volatility associated with that. So to cage your brain, 5% is really pretty good, right? So don't be upset with that. But I think really anything above 4% is kind of where I say that, yeah, it's worth it for the risk-free portion of that. So we're probably going to be able to do this for a while. But as Mike talked to, eventually the rates are going to come down, whether it's this year, like we projected now, 2 rate cuts later in the year, or it's next year. It's happening. We just, the timing will be questionable. But when that happens, you're going to see CDs, which is hard to say, down towards that 4% or so. And what we're doing right now is we're locking it in for, a year if we can. But as those terms become shorter and the coupons become lower, we're going to start getting back into that investment bond, whether it's using funds like VCLT is one of our favorites that we have, top 10 holding for us for long-term bond exposure out of Vanguard, or other options, whether it's individual bonds. And that's going to be the play moving forward. And again, bonds are out to that 3 to 7 years. You can go out to 30 years, but nobody really does that. But, 3 to 7 is kind of that sweet spot of let's go out far enough in time to be able to get a good rate and then get paid that rate for that 3 to 7 years that we hold that bond to maturity. That's if you're using individual bonds. So back to the original question, which you can still get 5% on CDs if you go through us. If you're going to your local bank, you can probably get 4.5. That's what I've kind of heard folks saying lately. So again, we can do better because we're not a bank. We don't take that cut, right? So you get the full the full CD. So that's all I have for CD. So hopefully you like talking about the economy today. Talked about Mike's favorite CEO and Jensen. Last check, nope, no friend request yet. And he's had 3 or 4 minutes. So now I'm disappointed like Mike, because I know he should be on LinkedIn right now instead of running Nvidia. And then lastly, I hope you enjoyed learning about CDs because this is going to disappear. And we're not going to be able to talk about CDs going into next year or so. With that, that's all we've got for today's show, and we will catch you guys back tomorrow. You have a good one.